Is my technology? Oh, okay. I think my technology is working. Okay. Well, welcome everyone. Welcome to the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. And this week's topic is tax strategies for real estate investment. So we work with a lot, as you know, a lot of our clients are in the construction industry. And so many of them, through their own businesses, through their own connections, tend to get involved in real estate investment, whether that's going to be real estate, commercial real estate, so commercial rentals, residential rentals, or even some of our clients are doing are flipping. There are going to be tax strategies. There are going to be tax things that you have to think about when you are getting involved with real estate investment. Like anything else, do your homework in advance, do your due diligence, and determine whether or not it actually makes sense for you. It is a way to build wealth, but if you aren't familiar with the strategies, not just tax strategies, but the overall how to invest or knowing a lot about real estate, it can be challenging. So like anything else, do your diligence in advance, understand what it goes into being a real estate developer before you just haul off and buy a piece of property. But we're going to talk about some of the things that you want to think about from an accounting and tax perspective when you are getting involved with real estate investment. So first, your rental income. So any income that you earn from your rental properties is going to be taxed as ordinary income. When you sell those properties, that's when you would potentially be subject to capital gains or capital losses. We definitely don't want to see you with losses, but there are times where people do have losses on their properties. So something to kind of think about there is that right now there are preferential rates for capital gains. So for long term, so you'd probably be falling somewhere around in the 20% tax bracket for that. If you were to sell a property, most of our clients tend to fall in that tax rate for any capital gains. If you've only held the property for a short time, which is under a year or a year and under, it would be taxed to you as ordinary income. So again, something to think about when you are holding the property. How long do you want to hold it? Because the way it will be taxed to you, depending on how long you held it, may change your decision making as to whether or not you may want to get rid of or sell the property. And something to also think about too is because you've been depreciating that property while you have been renting it and earning that income, there is going to be some depreciation recapture on the backside of it, which can cause certain tax issues for you. So all things to think about, something that you want to have a conversation with your tax practitioner about as you are thinking about selling a property. How's it going to affect you in this year? Can you potentially move a sale into another year if it makes more sense, and so on? We've talked about, harvesting your gains and your losses. So again, if you have a loss or a gain on the property, do you have losses from other places that you may potentially be able to offset it against? So again, it goes into an overall planning process, something to think about while you are when you are becoming a real estate investor, and then you're actually in the act of being an investor. Common tax deductions. So deductions for that you can apply against the rental income you've earned, your mortgage interest or interest on any loans, real estate taxes, insurance on the property, small repairs on the property. If you are investing in residential properties, is your rental in an area where there is an HOA? So maybe there's an HOA fee. So those tend to be the typical expenses that you get to take against the income you earn on your rental properties. That is not an exhaustive list, of course, but that tends to be kind of the top list, that, the go-to list of expenses that everyone will run into. So you're going to have, as I mentioned, you're going to have different types of real estate investment. So you may have commercial rental. So maybe you've purchased a small plaza with a number of shops in it. or you're into residential rentals. So going the long-term rentals with long-term renters in there, you've rented multiple apartments, or you have a house for rent, or you're going the way of VRBO or Airbnb, and you're doing a short-term rental. And then the last, or not the only one, but also flipping. We tend to have a lot of clients who are in the space of buying and flipping property. So buying, fixing them up, and selling them. So again, those are the different types of real estate investments that you can get involved with. And again, if most real estate investors, unless their entire business is real estate investing, they're doing nothing else, most of them typically will not, it will be what is called passive income to them. And it's because it's not an active trade or business, that they're not spending more than 1,000 hours a year engaged in. So if you have 2 or 3 rental properties, you are, you're a real estate investor, but you are not in the trade or business of real estate investing. So that income earned to you would be considered passive income. And those are going to have, passive income is going to have, and passive losses will have slightly different drawbacks, benefits, ways that it affects your overall tax liability. And again, it's something that you want to have a conversation with your practitioner, your CPA, your EA that you're working with, so that you understand how that may potentially affect your overall income when you are filing your tax return on an annual basis. So some of the planning strategies, depreciation. So there are different types of depreciation on the properties, depending on the whether it's residential or it's commercial. They have different lives. You're going to depreciate them differently. There may potentially be accelerated ways to depreciate them. One of the ways is doing what's called a cost segregation study. And on a very high level, what is happening is a study is done on your property. They're going to take all the bits and pieces of that property, the electrical, the plumbing, the roof, and each one of those is going to have a different depreciable life versus just saying it's a residential rental, it appreciates over 27 and a half years. Now we're taking all the components of that property and it's getting depreciated at different times. And in most cases, accelerating the depreciation instead of it just being equally over those 27 and a half years. You're having different portions of the property that are getting, the depreciation is accelerated. So there's significant tax savings there that you can find when you do a cost segregation study. We happen to work with an outside partner that does that. There are companies that actually specialize in it because it is a specialty credit. So we partner with a company who handles all of the cost segregation studies for our clients, and we let the specialists take care of the special credits, and then help our clients get the biggest bang from their tax savings when doing a cost segregation study. You could potentially do something called a 1031 exchange, which is you're basically doing an equal exchange for the property. I'm not going to go into a ton of detail, but keep in mind it is a potential tax break. You're going to hold that investment. You're going to swap it for something that's equal to it. You're going to basically you're deferring the gain that you would have gotten on the first property until you settle or you end up selling the second property. 1031 exchanges have to be done correctly, just like the cost segregation study. You want to find a professional, a company, a consultant that specializes in the 1031 exchange. You have only 60 days to do your exchange. It has to be properly documented. This is one of those types of tax savings opportunities that has to be documented to the T. And so you want to make sure that you're working with a professional that can ensure that you've kind of dotted your I's and crossed your T's to ensure that you actually you are going to get that tax savings. Again, there's no limit on the number of 1031s that you can do. Just keep in mind, it's a strategy, and it is a strategy that it can be very beneficial but you have to make sure that you document it properly, and it has to be an equal exchange for a property, like similar to what you have. So it would be a residential for a residential. You're not going to be swapping different things when you're doing a 1031 exchange, but it could be if you have a significant amount of gain on that first property, it could be quite preferential for you to try to move that gain into subsequent years down the road. So again, it's a great tool, but you want to make sure that it is properly documented. That is not one can get quite expensive if you don't follow all the rules, and you want to make sure you don't want to lose out on that tax deduction. So work with a professional. There are companies that specialize in doing the 1031 exchanges. We'll talk a little bit about entity structure. We've done that before previously, but there's going to be reasons to do, like anything else, there's reasons to do certain things and not to do other things. So again, your sole proprietor is going to be the easiest one to manage, but you, the owner, are personally liable. Partnerships, again, easy to create. It's hard to transfer your interests from one to the other, so may or may not be a good option for you. There's going to be your C Corp. It is it's an entity of its own. It sits separate from you as the owner, but you may be, or you will be, double taxed. So maybe a C Corp is or isn't a good option for you. And then you have your S Corp, which does offer you the liability protection, but you could potentially be subject to things like what's called built-in gains, passive income, passive loss limitations, so on. So each one of them has its benefits and each one has its drawbacks. So you want to look at your own unique situation when choosing the type of entity that you want to use when you are getting into your real estate investment. We always recommend that you have some type of entity structure in place because you do want to ensure that you protect yourself against any potential, liabilities that may come up. Again, someone slips and falls on your property. You want to make sure that you are protected, not just insurance wise, but again, having an entity structure of some kind that protects you against any kind of liability. We tend to have tax law changes pretty consistently year over year in some way. They may not be huge tax changes, might be small tweaks, but keep in mind, there's always going to be something new on the horizon or new for this year. The depreciation rules tend to change a little bit every couple of years. There'll be shifts. Accelerated depreciations you'll get limitations on them, or they'll change, or the strategy related to the acceleration changes. So something to keep in mind. Depreciation tends to be, especially in real estate investment, tends to be one of those things that will change, year to year. So when you purchase a property and you begin to depreciate it, how you look at or how you determine how you're going to depreciate it may be affected by what year you're in or what the new tax law changes or anything like that. The other thing, there is something called Section 179D, which is going to be your energy efficient commercial building deduction. There have been some adjustments to that in the last couple of years. That particular credit has become a lot more lucrative. There are a lot of opportunities there. That is something, again, like the cost segregation, like the 1031. There are professionals in this area that actually specialize in those types of deductions and credits. And we typically partner with those individuals because they are the experts in those areas in order to work with our clients and get them the biggest deduction that they can, again, within all the proper rules. But again, the energy efficient commercial building deduction is become much more lucrative in the last couple of years. So that's definitely something you want to talk to your tax professional about, see if you are potentially eligible for that credit. And, like anything else that we talk about here, do your homework in advance. You want to make sure that you understand what you're getting into. So do your due diligence when it comes to making that first real estate investment purchase. There is money to be made in the space, but you want to make sure that you understand what your obligations are, what your liabilities are, where you're potentially exposed, not only from a liability standpoint, but also from a tax standpoint. If you have any questions, please feel free to drop them in the chat. We love to hear from you. We'll respond to any of your questions that you have. And as always, we enjoy seeing you every Friday morning at 10 a.m. for the Construction CPA's Coffee Cafe. And we look forward to seeing you next week. Have a great weekend.